And I think that now we're starting to see the world wake up to this idea. The Indian central bank is thinking about introducing it as collateral in their banking system. The RBI, the Reserve Bank of India, is looking to do that at a 10-to-1 silver to gold ratio, which Dunnigan would imply a silver price of $400 an ounce today.
I think $100 silver is a very reasonable target over the next couple of years, and it's possible that it really overshoots. So I think, 100 is where you start taking serious profits, but don't sell everything, because there's the potential for the next parabolic run that could come sooner rather than later if silver breaks into 100.
Shawn Khunkhun and John Rubino highlight a rapidly shifting global recognition of silver's monetary power. What once seemed speculative is now being openly considered by major institutions. One striking example is the Reserve Bank of India's exploration of using silver as banking collateral at a 10-to-1 ratio to gold. This approach would imply a silver value near $400 an ounce under today's gold prices. This type of institutional acknowledgement signals that silver's role is expanding far beyond industrial use. Both analysts emphasize that $100 silver within the next few years is not only realistic but increasingly conservative, as structural deficits deepen and broader monetary stress intensifies. They argue that crossing the $100 threshold could trigger the next parabolic phase, making it a logical zone for profit-taking, while still keeping exposure for a potential sharper upside move. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
Something happened in September of 2010 where I made a significant silver investment, and it went up 1,100% in 6 months. And then it just caught my attention, and I thought, there's something here I need to focus on, and I started studying history, and I started understanding the relationship, both the natural relationship between silver and gold, and how, silver and gold have, really acted as money for the last 5,000 years. And then I started really realizing how scarce silver deposits were. So the takeaway, my long-winded answer and conclusion is, I sought out a silver-centric opportunity because I was convinced we were headed back into a time where gold was going to become very relevant. So I left the precious metals mining industry in 2011, and I started focusing on base metal mining, copper mining, zinc mining from 2011 to 2014. I came back to gold in 2014. I came back to silver in 2018, and I was deliberate in seeking out a silver-centric opportunity, because not only does silver outperform gold in a precious metals bull market, but what's changed, Dunnigan, since the last time silver was relevant, 2011, or very relevant, 1979, 1980, what's changed is the industrial demand for silver has significantly increased. So this next time, and we're in it, we're in it right now, this next time that monetary bid comes in for silver, the investors who are seeking safety outside of dollars and are going to look for silver to play the role that gold plays as a hedge, as a safety against systemic risk, as a hedge against bad government decisions, as a hedge against the fiat currency. Those monetary precious metals investors are going to be competing with industrial buyers who need the metal for solar panels, for EVs, for the military-industrial complex. There's 500 ounces of silver that go into a Tomahawk missile. So what we've seen is a 200 million ounce annual deficit for silver. And so I've chosen silver, and I'm convinced it is the greatest investment in this moment in ever. It is the number one investment. If you said, Shawn, there's only one investment you could participate in, it would be silver. And I think that now we're starting to see the world wake up to this idea. The Indian central bank is thinking about introducing it as collateral in their banking system. The RBI, the Reserve Bank of India, is looking to do that at a 10-to-1 silver to gold ratio, which Dunnigan would imply a silver price of $400 an ounce today.
People have kind of known that in theory for a long time, but now it's becoming more real. And you're seeing the central banks of the world just snarf up all the gold they can get a hold of. And people are taking their cue from those central banks. So there's a lot of gold buying across the board now. And then with silver, silver always had two really good stories. It was a monetary metal attached to gold in a lot of ways, and an industrial metal that we actually really need, and that if it was just an industrial metal, we would still be running a silver deficit that'll turn into a shortage that'll blow the price way up. So I think people are recognizing that too, including the U.S. government that just named silver a critical mineral.
Right.
Or critical metal. And meaning that, the U.S. economy does not function without the metals on that list, and silver is one of them. So now there's going to be a lot of stockpiling where if you make, say, missiles, for instance, or solar panels or whatever, you've got to have a certain amount of silver available in order to meet the orders that are coming in. And you can't just wait until the day before you need it and buy it on the spot market anymore, because spot markets are unreliable, especially for crucial things like silver now is. And so what you're going to do is stockpile. You're going to buy ahead of time. And I think that's a lot of the demand for silver too, is people who might not be using it right away, but they want it to be there when they need it. You put those two things together, and gold is not that huge of a market, but it's much bigger than silver. So with central banks buying gold, that's a wind at gold's back for as far as the eye can see. And with silver, the fact that it's just a tiny little market, it's thinly traded. There's just not that much silver out there. And we're using up above ground stocks at an accelerating rate. So I think there's a real possibility of a silver squeeze here that people have been talking about for a while. And I think, there's a decent chance that that's something that happens in some form in the next few years, where the metals exchanges just, start intimating that they don't have enough silver, and then somebody proves it by defaulting and paying out in cash on futures contracts instead of physical silver, and then boom, that's it. Then you get your triple digit silver with a bullet. There's no real upside limit to a tiny, thinly traded market that is suddenly in default, So I think $100 silver is a very reasonable target over the next couple of years, and it's possible that it really overshoots. So I think, 100 is where you start taking serious profits, but don't sell everything, because there's the potential for the next parabolic run. And that could come sooner rather than later.
Shawn Khunkhun and John Rubino trace how a single investment moment in 2010 led to a deeper understanding of silver's historic role, its rarity, and the accelerating forces now pushing it back to monetary relevance. Silver's industrial demand has surged far beyond what existed in previous bull cycles, with solar, EVs, defense systems, and advanced manufacturing consuming more metal than global mines can replace. This strain has created persistent deficits exceeding 200 million ounces annually. At the same time, investors seeking safety from systemic risk are returning to precious metals, competing directly with industrial buyers. With central banks stockpiling gold and governments classifying silver as a critical mineral, both analysts see conditions forming for tightening supply, potential exchange stress, and the kind of squeeze that could propel silver into triple-digit territory. Let's get into the interview.
Silver and gold are going to protect you from government stupidity. And they're going to be a store of wealth. They're going to be a hedge against inflation. They're going to be a hedge against systemic risk. Now, you should go out and you should own some physical silver and gold. Now, what the mining stocks, the mining equities do is they're a proxy. They're leverage to that underlying bullion. The bullion's the best place to be. But where the mining stocks have a lot of performance is, I'll give you an example. So when I started with Dolly Varden, we had about 40 million ounces of silver estimated through our third-party verification studies. And that 40 million ounces of silver was valued at pennies an ounce in the ground. Today, with the price rising and with our successful exploration and acquisitive transactions where we've acquired more silver, we found more silver, and with the price rising, why our share price has gone up, why the value of the company is increased, is because as that silver becomes worth more, so does the metal that we have in the ground. And so my next step in this strategy, as we've grown from a $20 million business to a $500 million business, as the share price has gone, from 50 cents to $4 USD. The next step now is we need to start focusing on operations. So in terms of upcoming catalysts, yes, we have more drill results coming. And I'll give you an example. On Monday, the gold price was up $100. The silver price was up over $1. And a lot of the mining equities were up 3%. Well, our shares were up 8% on Monday. And I believe the reason for that was because of the find, because of the discovery, because of the positive drill results. So I have 80 more drill results coming. And if they're positive, we should outperform our peers if we're adding to that mineral inventory. But to the second component there is I'm looking to try to accomplish more accretive M&A transactions. We've successfully completed 5. So if you look at there's a presentation on our website that takes you through all the results, that takes you through the strategy, that takes you through our place in the market. It also talks about upcoming catalysts. And upcoming catalysts are those drill results, but they're also more due diligence on further M&A transactions.
I would go out on a limb and say absolutely nobody actually knows what's going to happen in the next 6 months. Although a lot of people make careers out of those kinds of predictions, but there are very few billionaire short-term traders out there because it's just very hard to do. What you want to do with any kind of investment, but with commodities in general and gold and silver specifically, is you just want to be in the, on the train that's leaving the station. You don't know when it's going to leave, but you know what direction it's going to go eventually. And you just want to be there. You want to be on the right side of history, which in the case of commodities is shortages leading to much higher prices because of either industrial demand or monetary demand. Uranium and copper, it's industrial demand. They are needed for next generation power plants and power transmission. Silver is needed basically everywhere, but also as a monetary metal. It's the kind of thing that if gold gets too expensive, which for a lot of people it is in a visual sense, like you put a grand in the palm of your hand and it just looks like this small gold coin. It's like the size of an old silver or $50. But it's worth $4,000 now, and then you think, all right, what does $4,000 worth of silver look like? And it's a nice big pile of beautiful metal sitting on your table, So at this point in precious metals bull markets, we start doing that kind of a calculation. All right, gold's going to go up, but boy, is it expensive. Look how much silver I can get for the price of 1 gold ounce. And then people start buying silver. And then you get the parabolic move up because, like I said, it's a very thinly traded market. You get just a little bit of extra generalist money coming into the sector, or at least a little bit by comparison with generalist money. And it'll push silver way up. And I think that's the kind of thing that we will see pretty soon. It might be 5 years or it might be next week. That's the thing. So you want to be positioned now because you're hearing all this stuff, right, about different commodities exchanges where the amount of silver they've got on hand is falling precipitously, and it's not clear how much more is going to be left because more and more futures contract players are standing for delivery. And all you need is one contract on the COMEX to be settled in cash instead of metal, and boom, silver becomes unobtainium and it goes straight up.
What this discussion makes unmistakably clear is that the combination of structural metal shortages and rising monetary stress is pulling silver and gold into a new phase of strategic importance. Physical ownership remains the foundation, shielding investors from policy errors, inflation, and systemic fragility, while mining equities offer leveraged upside as discoveries, resource growth, and disciplined acquisitions translate directly into expanding in-ground value. The broader backdrop is equally compelling. Industrial demand continues to surge, above-ground stocks are thinning, and futures markets are being tested by rising delivery pressure. As gold's price climbs, silver's relative affordability and thin liquidity become catalysts for rapid, outsized moves when new capital enters the sector. In an environment where timing is unpredictable but direction is clear, positioning early remains the advantage. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.